Silver did not move the way it did by accident. It did not surge because of retail hype, and it certainly did not rise because a few investors suddenly became interested in precious metals. Something far more structural happened, behind the scenes. While most of the financial world was distracted by stock rallies and tech headlines, the global commodity system began to fracture. Physical supply started disappearing faster than the paper markets could explain it. And when that happens, prices do not simply rise, they reprice the entire system. Silver was only the first signal, because right now, 5 other assets are quietly moving toward the exact same pressure point. And when they cross it, the financial landscape could change faster than most investors are prepared for. But here's the real question. Which assets are next? And why are the largest institutions already positioning themselves before the public even notices? Welcome to Financial Crisis Explained, the place where complex economic shifts are broken down with clarity and evidence. And before we go further, a small request, especially to the wise viewers watching who have seen markets rise and fall many times before. If you appreciate calm, serious analysis instead of noise, consider subscribing to the channel. It helps this research reach more people who are trying to understand where the global economy may be heading next. And one more thing, tell us in the comments, where in the world are you watching this video from today? For most observers, the silver rally appeared sudden. Charts moved quickly, headlines followed, and commentators rushed to explain the move using familiar language, retail enthusiasm, speculative flows, or temporary commodity momentum. But beneath the surface of those explanations, something far more structural had already begun unfolding. Silver did not rally because traders suddenly discovered it. It rallied because the physical metal was quietly disappearing from the system faster than the financial markets could continue pretending it was still there. And that difference between paper supply and physical reality has become one of the most dangerous gaps in global finance today. To understand why silver moved the way it did, one must first understand how modern commodity markets actually function. Most commodities are not priced primarily through the physical exchange of the resource itself. Instead, prices are determined through enormous derivative markets, futures contracts, options, and synthetic exposure that allow investors to trade price movements without ever touching the underlying material. In theory, this structure creates liquidity and efficiency. But it also creates something else. It allows the financial system to create multiple claims on the same physical supply. In practical terms, that means 1 ounce of silver stored somewhere in the world can support numerous paper contracts trading simultaneously across global exchanges. Under normal conditions, this arrangement works because only a small percentage of contracts ever demand physical delivery. Most positions are simply settled financially. But the stability of this system depends on one assumption: that the underlying physical supply will always remain abundant enough to satisfy the small number of investors who eventually ask for delivery. The moment that assumption begins to weaken, the entire pricing structure becomes vulnerable. And throughout the past several years, the pressure on physical silver had been quietly building. The first force came from industry. Silver is not merely a precious metal used for coins or jewelry. It is one of the most efficient electrical conductors known, making it essential in modern technological infrastructure. Solar photovoltaic panels require it. Electric vehicles depend on it for electrical connections and battery systems. Semiconductor manufacturing relies on its conductivity. And the rapid expansion of artificial intelligence infrastructure has increased demand for high-performance electronics that also depend on silver components. In other words, industrial demand was not growing slowly, it was accelerating. At the same time, the supply side of the market had been weakening for nearly a decade. During the long period when silver prices remained suppressed, mining companies reduced capital expenditure. Exploration budgets were cut, new projects were delayed, and many mines focused on extracting other metals that were considered more economically attractive. Mining, however, is not an industry that can suddenly expand production when prices rise. New discoveries take years to develop. Permits require long approval processes. Infrastructure must be built before extraction can begin. So when industrial demand began climbing rapidly, the supply pipeline was already thin. But the third force was the one most investors failed to notice. Quietly and often outside the spotlight of financial media, institutional capital had started shifting its preferences. Large funds, sovereign wealth entities, and even central banks were gradually reducing exposure to purely financial assets. After years of unprecedented monetary expansion across the global economy, many institutions had begun asking a difficult question. What happens if financial assets are no longer the safest store of value? The answer, for many of them, was a return to assets with physical scarcity. Commodities, energy, strategic metals, real resources that cannot be printed or digitally expanded. When these three forces collided, rising industrial demand, constrained mining supply, and increasing institutional accumulation, the silver market reached a tipping point. At first, the change was subtle. Inventory levels began declining, physical premiums widened, delivery times lengthened. But once the imbalance became visible to larger market participants, price behavior changed rapidly. Silver did not simply drift upward, it repriced. And that distinction matters, because repricing events rarely stop with a single asset. They reveal structural pressures that often exist across entire sectors of the global economy. Silver, in many ways, was simply the first commodity where these pressures became impossible to ignore. The mechanisms that moved it, scarcity, industrial necessity, and institutional capital rotation, are not unique to silver alone. They exist in other markets as well. And for investors paying close attention, the silver rally was not the end of a story. It was the beginning of a pattern. Because when the financial system begins rediscovering the value of scarce physical resources, capital rarely stops at just one metal. It starts searching for the next imbalance. And in today's global economy, several of them are already forming. Most investors still believe the silver rally was an isolated event, a commodity spike, a temporary imbalance, a moment of speculative enthusiasm that eventually settles back into normal price behavior. But the institutions that quietly study global resource flows do not see it that way. From their perspective, silver was not a rally, it was a signal. A signal that the global economic system may be entering something far larger, a phase where real, scarce assets begin reclaiming value after decades of financial asset dominance. To understand why this shift is emerging now, one must step back and examine how the modern financial era was built. For nearly 40 years, the global economy operated under conditions that strongly favored financial assets. Interest rates steadily declined. Central banks injected liquidity into markets whenever instability appeared. And the expansion of financial instruments allowed capital to move rapidly between stocks, bonds, and derivatives. This environment created an extraordinary period of financialization. Companies were valued more by future expectations than present resources. Entire industries developed around managing financial exposure rather than producing physical goods. And for many investors, commodities became almost irrelevant, relics of an earlier economic era. But the real world never stopped running on physical inputs. Energy still powered industries. Metals still built infrastructure. Food still sustained populations. And the systems responsible for producing those resources quietly began facing increasing pressure. Mining projects became harder to develop. Environmental regulations slowed approvals. Energy exploration declined after years of low prices. Agricultural systems faced climate volatility and fertilizer shortages. While financial markets expanded in complexity, the physical foundation of the global economy was becoming more fragile. For a long time, those pressures remained hidden. Commodity prices stayed relatively stable, supply chains appeared reliable, and global trade networks absorbed disruptions before they became visible to investors. But structural imbalances rarely remain invisible forever. Eventually, the physical economy begins pushing back against financial assumptions. One of the earliest signs of that pushback is persistent resource scarcity, not temporary shortages caused by weather or geopolitical tension, but deeper, structural limitations where supply growth simply cannot keep up with rising demand. And across multiple sectors of the global economy, those limitations are beginning to appear simultaneously. Energy demand continues rising as developing nations industrialize. Electrification initiatives require vast amounts of copper, lithium, and rare metals. Food production must expand to support a growing global population. And new technologies, artificial intelligence, advanced computing, and renewable energy, depend heavily on specialized materials that are difficult to extract. In other words, the modern digital economy is built on a physical resource base that is far tighter than most financial models assumed. At the same time, another structural shift is occurring within the world of capital allocation. Large institutions are beginning to question whether traditional financial assets can maintain purchasing power in a world of persistent monetary expansion. Over the past 2 decades, global debt levels have increased dramatically. Governments have relied on borrowing to stabilize economic growth. Central banks have expanded their balance sheets to support financial markets during periods of stress. These policies prevented immediate crises, but they also introduced a long-term concern. If currencies can be expanded rapidly to stabilize the financial system, the relative scarcity of real assets becomes more valuable. This realization has quietly influenced the behavior of institutional investors. Sovereign wealth funds have increased exposure to infrastructure, energy, and commodities. Central banks have accelerated purchases of strategic resources and precious metals. Pension funds have begun allocating capital toward tangible assets that can maintain value regardless of currency fluctuations. This shift rarely appears dramatic in headlines. Institutional capital does not move with the speed of retail speculation. It moves gradually, deliberately, and often quietly. Positions are accumulated over years rather than days. But once the direction of that capital becomes clear, markets can reprice far more quickly than expected. because financial markets operate on expectations. And when expectations shift from abundance to scarcity, the value of physical resources changes dramatically. That is the environment now forming beneath the surface of the global economy. Silver was simply the first commodity where these forces converged visibly. Industrial demand surged, supply remained constrained, and institutional capital began recognizing the imbalance. But the mechanism that produced silver's move is not unique. The same structural pressures exist across multiple resource markets. Energy systems are tightening. Critical metals face rising demand. Food security is becoming a strategic priority for nations. And the financial system is slowly rediscovering the importance of real, irreplaceable resources. This is why some analysts describe the current moment not as a commodity rally, but as the early stage of a hard asset repricing cycle. A period where capital gradually shifts away from purely financial assets and back toward the physical foundations of the global economy. If that cycle is indeed beginning, then silver was not the destination, it was the opening move. Because when one asset reveals a structural imbalance, investors immediately begin searching for others. And right now, 5 specific markets are showing the same early warning signals that silver displayed before its move began. When a structural repricing begins in one market, the most important question is never about the asset that already moved. It is about the ones that have not moved yet. Because financial history rarely shows isolated events. Markets move in sequences. One resource breaks its pricing structure, institutions recognize the imbalance, and capital immediately begins scanning for other assets where the same forces are quietly building. That is exactly what happened after silver. Within institutional commodity research circles, analysts began asking a different kind of question. Not why did silver rise, but rather, where else does the same imbalance exist? And when those analysts began comparing supply data, industrial demand forecasts, and global inventory levels, a small group of resources began appearing repeatedly in their models. 5 assets, each of them essential to modern industry, each of them facing tightening supply conditions, and each of them quietly attracting the attention of long-term institutional capital. The first is uranium. For decades, nuclear energy existed in a strange position within global energy policy. Many countries relied on it for stable electricity, yet political hesitation slowed investment in new facilities. As a result, uranium production stagnated for years. Mining companies reduced output, projects were delayed, and inventories slowly declined. But while supply remained limited, a different shift began taking place in the global energy conversation. Governments searching for reliable, low-carbon power started reconsidering nuclear energy. Unlike solar or wind, nuclear reactors provide constant baseload electricity. And in an era where electricity demand is rising rapidly due to artificial intelligence infrastructure and electrified transportation, that reliability has become strategically valuable. The moment reactor construction accelerates faster than uranium production can respond, the imbalance becomes clear, and institutions have begun noticing that gap. The second asset attracting attention is copper. Copper rarely captures headlines in the way precious metals do, yet it may be the single most important metal in the electrification of the global economy. Every electric vehicle requires significantly more copper than a traditional car. Renewable energy infrastructure relies heavily on copper wiring. Power grids expanding to support electrification require massive quantities of it. And yet, copper mining faces a quiet problem. Many of the world's largest deposits are aging, ore grades are declining, and developing new mines often takes more than a decade due to environmental approvals and infrastructure challenges. Demand, however, is accelerating now. When those timelines collide, markets begin anticipating future shortages, and prices eventually respond. The third category lies at the foundation of the entire global economy: energy resources, particularly oil and natural gas. Despite narratives surrounding energy transitions, global consumption of fossil fuels has remained remarkably resilient. Industrial activity, transportation networks, and developing economies still depend heavily on them. Yet investment in new exploration has declined in recent years. Energy companies, responding to both political pressure and shareholder demands for discipline, have reduced large-scale exploration budgets. This creates a subtle but important effect. Production remains stable in the short term, but the pipeline of future supply becomes thinner. Over time, that lack of investment can produce tight energy markets. And tight energy markets ripple across every other sector of the economy. The fourth asset class involves something even more fundamental: agricultural commodities. Food rarely behaves like a traditional investment asset. Yet from a geopolitical perspective, food security has become one of the most strategic priorities of modern governments. Population growth continues increasing global demand. Climate volatility affects harvest stability. And fertilizer markets have experienced disruptions that influence crop yields worldwide. When agricultural systems face simultaneous environmental and economic pressures, supply uncertainty increases, and food-producing resources begin gaining strategic importance. Finally, the fifth asset category sits at the intersection of technology and geopolitics. Rare earth elements. These metals are essential components in advanced electronics, defense systems, renewable energy technologies, and high-performance computing hardware. But their supply chains are highly concentrated. A significant portion of global rare earth production is controlled by only a few regions. That concentration introduces geopolitical risk. If technological demand continues accelerating while supply remains geographically limited, nations and institutions begin competing for secure access, and markets eventually reflect that competition. What makes these 5 assets particularly important is not simply their individual fundamentals, it is the pattern they share. Each of them supports essential infrastructure of the modern world. Each of them faces constrained supply expansion, and each of them is beginning to appear more frequently in long-term institutional investment strategies. This does not guarantee immediate price spikes. Institutional capital rarely moves impulsively. It accumulates positions gradually, often years before the broader market notices. But when those positions reach a critical mass, and when supply limitations become visible to the wider financial system, price adjustments can happen with surprising speed. Silver demonstrated how quickly a market can reprice when physical scarcity collides with financial expectations. The 5 assets now drawing institutional attention share many of those same characteristics, which raises a deeper question. If institutions are already studying these markets closely, and if capital is quietly positioning itself before the imbalance becomes obvious, then the real advantage may not lie in predicting the exact timing of the next move. It lies in understanding who moves first and why. By the time a commodity appears in headlines, the most important move has usually already happened. Prices may still be rising, public attention may just be beginning, and retail investors may believe they are discovering an opportunity early. But in many cases, the foundations of that opportunity were recognized years earlier by institutions quietly studying the structure of the global economy. Large capital allocators rarely rely on market excitement to guide their decisions. Their process is slower, more methodical, and far more data-driven. Instead of reacting to price movements, they analyze the deeper mechanics that eventually cause those movements to occur. Commodity inventories, production timelines, industrial demand projections, geopolitical supply risks. These are the signals institutional research teams monitor constantly. Because when the physical foundation of a market begins tightening, the price adjustment may be delayed, but it is rarely avoided. This is the reason institutional capital tends to move long before the public narrative changes. The first stage of that movement is often invisible. Quiet accumulation. Positions are built slowly through direct commodity exposure, long-term contracts, infrastructure investments, or strategic partnerships with producers. At this stage, prices may not move dramatically. In fact, markets often appear stagnant. But beneath that calm surface, supply is gradually being absorbed. Inventories shrink, available material becomes harder to secure, and the imbalance between supply and demand begins quietly widening. Eventually, however, the market reaches a threshold. This is the moment when scarcity becomes visible. Producers begin warning about limited output, delivery delays increase, physical premiums rise relative to futures prices. Once those signals become obvious, the broader financial system begins reacting. Analysts revise forecasts. Media coverage expands. Retail investors begin paying attention, and prices start moving rapidly. But by that stage, institutions are no longer accumulating. They are already positioned. This pattern has repeated throughout modern financial history. Oil shocks in the 1970s, gold's repricing during periods of currency instability, agricultural commodity spikes following supply disruptions. In each case, the initial accumulation phase occurred quietly before the public narrative shifted. The same dynamic may now be unfolding across the resource markets that support the modern global economy. Energy infrastructure, critical metals, strategic minerals, food systems. Each of these sectors faces pressures created by the same structural forces that moved silver earlier. Industrial demand is rising, supply expansion is constrained, and institutional capital is gradually rediscovering the strategic importance of physical resources. What makes the current moment particularly significant is the broader financial environment surrounding these markets. Global debt levels remain historically high. Central banks continue balancing economic stability with monetary expansion. And investors are increasingly questioning how traditional financial assets will behave in a world where currency supply can expand rapidly. In such an environment, assets with genuine scarcity gain a different kind of value, not merely as investments, but as anchors of stability within an increasingly complex financial system. That realization explains why institutional capital is studying hard assets more closely again, not as speculative trades, but as structural components of long-term portfolios. Silver was simply the first visible example of how quickly a market can change when physical scarcity collides with financial expectations. But the forces behind that move were never limited to one metal. They exist across multiple sectors of the global economy. And once institutions recognize a structural imbalance in one resource, their research rarely stops there. They begin scanning for the next pressure point, the next supply constraint, the next market where financial pricing assumptions no longer match physical reality. For entrepreneurs, investors, and business leaders, understanding this process matters more than predicting short-term price movements. Because markets driven by structural scarcity do not behave like ordinary cycles. They tend to move in phases. First comes quiet accumulation, then gradual recognition, and finally, rapid repricing once the imbalance becomes visible to everyone. Silver may have been the opening signal, but if the broader hard asset repricing cycle continues unfolding, the next phases may already be forming beneath the surface of the global economy. And by the time the headlines begin explaining them, the institutions that study these signals today may already be several steps ahead.